Morning, everyone, and thank you very much for joining me. This is the first morning market review of the week. Hope everyone had a good weekend. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. Today is Monday, it's the 18th of July 2022. Just going to go ahead, bring up our high-risk investment warning. I'm going to keep this on screen for a few moments. Morning, Katie. Nice to have you on the webinar. Hey, Anna. Morning to you. Thanks for joining, guys. Thanks for everyone signing in. Hope everyone is well. Here's our market commentaries disclaimer. And our references, MarketScope 2.0, CNBC, we'll start off with CNBC, and tradingview.com. We'll just we'll keep this screen for a moment just to show tell you what you're looking at. This is on the top. You're looking at the real rate, and on the bottom you're looking at the Nasdaq. We'll just go through that in a moment. Let's just go through our CNBC note. Hey Sam, morning to you. Thank you for joining. All right, so the headline from CNBC reads as follows: European markets head for cautiously higher open, continuing positive global trend. European stocks are set to open cautiously higher on Monday after gains seen last Friday, although Italy's main index is seen opening in negative territory amid political uncertainty. This comes amid more buoyant global sentiment. In Asia Pacific markets on Monday, Hong Kong's Hang Seng jumped more than 2%, while US stock index futures were modestly higher early on Monday morning after a positive end to the last week. Friday's relief rally came as traders bet that the Federal Reserve will be less aggressive at its upcoming meeting. The Wall Street Journal reported Sunday that the central bank is on track to lift interest rates by 75 basis points at its meeting later this month, rather than the larger full percentage point increase that some analysts had forecast. Recession fears have dominated trading sentiment in recent weeks as market participants worry that aggressive action from the Fed in an effort to tame decades high inflation will ultimately tip the economy into a recession. Last week, fresh inflation data showed consumer prices jumped 9.1% in June, a hotter than expected reading and the largest increase since 1981. That in turn led traders to bet that the Fed could raise rates by a full percentage point at its meeting at the end of July. Haleon shares are expected to commence trading on the London Stock Exchange's main market as an independent listed company. And that's after GSK shareholders approved the demerger of its consumer healthcare business. There's no major earnings or data releases Monday. Okay, cool. So I'm finding the markets, again, quite challenging. I'm trying to get a sort of a sense of direction, and it's difficult. There's no doubt that positive sentiment has crept into the market and seems to be sort of the order of the day. And I think that this has a large part to play. So this is the daily real interest rates, and just looking at this on an absolute basis. Let me pop this in here for. I'm just trying to adjust these settings. I forgot that there's a lag here. All right. Nevertheless, this will work for us. Yeah, I don't want to extend and I want to start it long. All right, that's better. All right. So we've got this. The real. So what are we looking at on the top? The top chart is real rates are coming down, and they've been coming down since about the middle of June on an absolute basis. And then the bottom chart here is the NASDAQ, which I'm just using as a proxy for a risk market. On an absolute basis, you can see it's heading up. So real rates, if they continue to come down, probably feeds into the risk sentiment. And of course, this is very much dependent on, I think, on the Fed. On, is it going to raise rates? Is it going to do the 75? Is it going to do the 100? It looks like it's 75. So I just wanted to show you guys something else here. It's quite a cool tool. Before we get to that, I'll use this screen. All right, so let's close this up. I want to show you guys the Fed Funds Futures, which is a ticker code ZQ. Okay, so you want to just take a look at the Federal Funds Futures, and if you click this sort of drop down here or this sort of menu button, you can take a look at all different time frames. So if we click in on July here, let's see what have we got. Let's change this to a line chart. So the way you want to use this is you want to use 100 as the base. Okay, so you'll take your calculator out, you'll take 100, and what you're going to do is you're going to subtract the reading that you have here. So we have 98.3175. And that gives me 1.68%. So that's kind of where we're at the moment. And then what you can do is let's take a look where it's going to be in 30 days. Let me do that again. Okay, let's just take up the 30 days one. What's the market telling us? Now we've got a slightly different number, so we'll take 100 and we'll subtract 97.63, giving us about 2.37. So we're kind of looking at that 75 basis points, right, to get us from the one reading to the other. And on a probability basis, I think the market's looking at about 70% chance of 75 basis points. It's oscillating between the 100 and 75, being data dependent. I'll show you why it's come down to 75 from 100. Something interesting happened on Friday. And then another interesting reading is if you take a look at the federal funds for year end, take a look at it. Where does the market expect the Fed funds to be at the end of the year? So you'll take 100 minus 96.485. 100 is the zero boundary, right? That's why we're subtracting it. And then so we're looking at about roughly about 3.5% by the end of the year. And either that's going to increase or decrease. If it increases, I think it feeds into the real interest rates, and that becomes a risk-off environment. If it decreases, again, that feeds into the real interest rates, but that becomes a risk-on environment. And it's, I think, quite useful just to go US 10-year minus your break-even, right? That's going to give you your real rates, and you'll take a look, and we'll just monitor this. Okay, so this is kind of what's driving the market at the moment on an interest basis. But the question is, well, why are we kind of oscillating between 100 and 75, and why has the market gone back from 100 to 75? And I think it comes down to actually retail sales. I think what happened here was very interesting. So the chart on the left is the retail numbers that came out and this is on a month-on-month basis. In fact, let me bring up Forex Factory just to show you guys, which wasn't in my sources, but I think that we must just reference it. So let's bring up Forex Factory. All right, so if I go through to Friday, so I'll just go, let's do this Friday the 15th, right? Let's just click on Friday the 15th, apply the settings. Friday the 15th, apply the settings. Okay, so here is our retail sales. So the forecast was for 0.9, came in at 1%. Core retail, you're taking out motor vehicles because they tend to be volatile. You just click on the folder here, it'll tell you what it's excluding, and it tells you here automobile sales are very volatile. So the core data takes those out. So it's retail sales ex auto, right? So that's what you're seeing for the core number. But let's just keep an eye on the retail number. It's jumped to 1%, and it's 0.9%, and so it looks pretty strong. However, there is a interesting trick to retail sales. Retail sales take in the price, the current price. In other words, the current inflation environment is included in the retail release. So now we go through to the right-hand chart. Now what I've done here, okay, is I've just taken the retail sales on a month-on-month, and I've minus US inflation on a month-on-month basis, which is USIRMM. So it's just kind of, that's what I've done. And then what you can see here is I've put in a red dashed line at 0, is that the retail sales actually not keeping up with the inflation. So you strip out inflation, and so sales are actually lagging. They're battling. They're not keeping up with the inflation. So it's exactly what I said last week. I went into the supermarket. I bought some coffee. I couldn't believe the price of the coffee. That gets noted in the retail sales, okay, that, well, there is a higher number of retail sales, but you take out that inflation adjustment, people aren't buying as much coffee because it's expensive, right? So that's what it's telling you here. So there is still softness that is behind that retail release, and I think that softness has got the market thinking, well, hang on, we've been quite aggressive with the rates. Maybe they're starting to work. I don't think there's a case for 100 basis points. Let's price in 75. I think 75. So we were maybe overly aggressive before in our thinking. So let's reprice. Remember, markets are efficient. Information flow is inefficient. So as soon as there is new information, it has to discount. And I think that's led us into a risk on environment for the time being. Now, does that mean that we are sort of out of the woods? I definitely don't think so. But of course, the transition between market cycles is always going to be difficult because you can only be 100% certain after the fact. So that's why I'm finding it so difficult. Are we, aren't we? I don't know. Of course, one useful measure is our yield curve, which is still very much inverted. So we'll just bring that up. And we very we're very steep in the inversion. We're at minus 0.2. The further down this goes, the steeper the inversion. The steeper the inversion, the more probable of recession. And again, well, if that's the case, then maybe this is just sort of a dead cat bounce, right? Maybe we're just getting some sort of correction in the broader trend. And if it is a bear market rally, well, that's where the damage is done. Remember, because everybody tries to be as optimistic as possible. The worst is behind us. Let's now commit ourselves, except if it's a bear market rally, it destroys a lot of wealth. So it's very tricky. Remember, it's very tricky. The inversion is still very much in play here. So I think that we keep an eye on that, and I think we keep an eye on those real rates. For those real rates to come down, I think that does help with the risk on environment. Another tool we want to reference, of course, is our COPOC. Now, the problem with the COPOC is it's a monthly indicator. So we can look at this every day, but we don't really get a real signal until the end of the month. So let's just go through to our SPX 500. And let's put this in. Let's just take a look at this on a monthly, see what the COPOC is suggesting. All right, just bear with me, just lags. Here we go. All right, let's put in the COPOC. Okay, so the COPOC hasn't reached that all-important 0 yet, which is a consideration. COPOC generally, okay, is a two trigger. It's a two trigger indicator. It needs to go below 0, and then it needs to turn up from below 0. Then you've got it. Then you've got it. Yeah, it's tricky, Rob. So Rob's just saying that he was going to ask on those rates. It's tricky, but I think that again, I think what we bottomed. I don't know. We'll only know after the fact. And if we have bottomed, then those real rates probably have sort of peaked. But if we haven't bottomed, you know, that's. So over here, the COPOC suggests perhaps we haven't, but it doesn't have to go below 0. It may turn up. The DAX has gone below, right? We know that. Okay, we have minus. So here we've got one out of 2. Okay, and these don't trigger all that often. So when you go below 0, it's meaningful. It's meaningful. Okay, so we're below now. Remember, we're on a monthly here. 2.5 here. So then you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 months of uptrend here. This one is quite shallow, and then you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 months of uptrend here. So you can see they're fairly meaningful when they turn up. Are you looking at the COPOC? Are you asking for the COPOC for the tech rec or for the Russell 2000, Chris? We'll do both, by the way, but I think you're asking for the Russell, which we can do. I'm just going to put in the RUT. Okay, so the small companies Yeah. Okay, so the small companies, we do have the one out of the two, right? So there we go. Okay, so the turn-up, if it turns up here, it can be prone to some false signals here. Remember, it's not it's fallible, not infallible, it's fallible. But we just use this to kind of help, and it's a broad sort of bird's eye view. Okay. What we will do, Chris, by the way, just take a look at it with regards to the tech rec. Just take a look actually at on a logarithmic scale here. Yeah. All right, let's just take a look here. So here is the first turn up in 99. Then it comes down. This is the next signal is a whipsaw signal. So here is a false signal from it. Okay, so they can generate, and then but the next one was the real deal. Okay, here's the global financial crisis, right? A little bit right about there. Okay, so these when they turn up, they tend to be really nice signals. Okay, but there are generally it's not a good idea to use this as the only indicator you can see, because we have these once in a while these false signals. Let's just go through to SPX and we'll go back to DAX. Yeah, Pam's asking, so I'm not a fan of using it on the daily. Pam, I think there are better indicators for the daily. I think they are more tested. This was designed as a monthly. It was designed as a monthly by a guy named Edwin Kopak, and he was a financial advisor. He specifically wanted for the primary trend. So for the daily, I wouldn't use it for the daily. If you are going to use it for the daily, you can test it. But what I worry about is something called because I'm definitely susceptible to it, but I would say it's a major problem in all testing. It's something called data mining or curve fitting. In other words, we look at something and we kind of play around with settings until it works on our test sample, So the idea here is, I think that if you're going to use it on the daily, just sort of make sure you test it out. Honestly, I haven't, but again, I think there's other tools that we can use. It's kind of, we use this from the top, and then we go down. Sam's, what's the default settings? The default settings are 10, 14, 11. These are the defaults. 10, 14, 11. 14, 11. I can actually go through the calculation with you. I didn't know at one stage. You basically adding, I think the 14 and the 11 together, and then I think that's what you're doing, and then you're taking the weighted average of them. But I'll just go to my notes and pick that up. What other tools? Well, I mean, with the other tools, everything that we use, and there's nothing hidden here. So, okay, so let's go through to the DAX. Okay, so okay, so now we know that there is a potential setup here. Cool. So now we'll go through to our other tools. Other tools is, well, let's take a look at this on a weekly basis. Okay, well, we've got some nice support coming in. Okay, is the stochastic moving out of the 20 area? Okay, will the RSI pop above 50? Okay, are we going to get into zone 1? Is the zone 1 expansion going to take place on the Bollinger's? All the stuff we've done, you know, so we put it all together. But I think that the COPOP is quite nice just to help with the primary analysis. So again, nothing hidden, just everything as we've always done, just adding an extra tool to it. So we've done COPOP, we've done real rates, we've done inversion, we've done the Fed funds futures. I'm just crossing these off my list. I think that's sort of a good start. Let's do some chart analysis now. Seeing we've got it up. Chris asking, to what extent will small companies act as a leading indicator? So I can tell you the theory there, Chris, is that it typically should be a leading indicator. It should be a leading indicator. So taking a look at the COPOC on the Russell 2000 is probably a good idea. We've just got to see it flick up, and the reasoning behind leading being a leading indicator is that, of course, they tend to be the first to benefit from because of the size. They're a little bit more nimble. They typically their risk profile adjusts quicker than a larger company, and I'm just saying, okay, so there's something that's just come to mind. I'm begging your pardon. It's just a tangent. Chris, I'm coming back. So there's something called, I hope I remember this. You can Google it. I hope I'm going to do this justice now. But it's worth introducing at this point, because Chris has asked the question. Okay, just bear with me. I know it's a Monday morning. I'll try not to make this too heavy, but I think it's just interesting because Chris asked me a very good question. He's saying, what about small companies? Can't we use them as a leading indicator? And the theory suggests that we can. But let's say, well, why? Why should it? So when we look at company risk, okay, we tend to look at something called, believe it or not, we tend to only view it in terms of market risk. We tend to view it in terms of how's the company risk related in terms of market risk. We tend to discount or ignore company risk. We tend to ignore it to some extent, and the reason for that is because company risk can be diversified away. So if you've got a very risky company and you put 100% of your cash into that, okay, you've assumed a huge amount of risk. But if you put it into two lots and you put half of it into the very risky company and half of it into a, let's just call it a money market account, that cuts your risk down considerably on your capital. You certainly are at much less risk just by diversifying from one company into two instruments. So the more you diversify, the less exposed you're going to be to company risk. So we tend to look at something called market risk and the way that we would analyze it, the way that we would look at market risk is how does a company's, what we call beta, okay, what is beta? What's a company's beta when we compare it to the market? If its beta equals 1, it's as risky as the market. It means that market risk is completely representative of the company risk. If your beta is 2, it means that the company is 2 times riskier than the market. Okay, if it's beta is 3, then it's 3 times riskier than the market. But we tend to look at it in terms of market risk. Now, just bear with me. Okay, beta, you'll find beta in any fundamental website you go to. You can go look at Apple's beta. You can go look at General Electric's beta. Take a look at any country, any company in any country's beta. So the question is, how does beta affect how we view a company? So you've got different models. Again, I'm not going to get too much into the mathematics because it's Monday morning. So you've got something called the CAPM, which is capital asset pricing model, is what we call a one-factor model. Okay? It only looks at one factor. What's the factor that it looks at? It looks at the company's beta, okay, and then kind of does a few bit of mathematical tricks, and then we'll come up with our. But then you've got something, and again, if you guys want more information here, beta's volatility. Beta, how volatile is your company compared with the volatility of the market? Okay, so the idea here is you've got something called the Farmer-French model. Just throwing this in there. Farmer-French model. Okay, Farmer-French model. Farmer-French model is a multi-factor. It's a multi-factor model. Okay, so what does now I've got to just remember this. I won't remember. There's three factors in the Farmer-French model. One of them would be the CAPM. So Farmer-French would take a look at CAPM. That would be the one factor. The other factor would be, okay, I know what the three are. Okay, the other factor that it would look at would be value. So under value versus over value. And the way that it would do that, it would look at its price to I think the book value of a company. Okay, I think that's the way it does it. That's the second factor. It would look at CAPM. It would look at undervalue versus overvalue. Now, the third factor of Farmer-French is exactly what Chris is referring to. Size. Okay, size. We look at it in terms of size. Okay, is it a large cap? Is it a large cap or is it a small cap? So effectively, what's happening, Chris, is that the risk. So what we're measuring here is company risk or company volatility. Okay, and out of that, as risk, we're measuring risk. Out of that, we want a required rate of return. So what would happen here, Chris, is that the size factor may be adjusting, giving the Russell that leading indicator status. In other words, just like there is a beta that goes into the CAPM, there's a separate beta that goes into value, and there's a separate beta that goes into the size. In other words, the betas that affect the other factors may be adjusting. So that's why the Russell could be a leading indicator, because whilst the beta for CAPM may be sort of sticking, and the beta for value may be sticking, perhaps it's the beta in size that's adjusting. We won't get, the betas are different, by the way. The base beta for CAPM is 1. The base betas for value and size is 0. Don't worry about that. Okay. So that's just a sort of the academic theory behind Chris's observation. Right? Does that? I hope that sort of makes sense. And is asking, how is it calculated? Gee, you're putting me on the spot. I've got to dig into my memory. I think I think it's calculated as follows. So you're going to have for beta, you're going to have company X, let's call it company X, measured against. I'll just do this for completeness, Anna. You've got company X measured against the market. Okay, company X measured against the market. Because that's the way we measuring it, right? So what you would do is, okay, it's a statistical formula, is you would take what's called the covariance of X against the market divided by standard deviation of company X multiplied by the standard deviation of the market equals beta. There we go. All right. But let's drop that. As I say, if you guys want to just Google Farmer French, it's probably worth doing that. Let's take a look at some charts. All right, so what's happening here is lower peak, lower trough. That hasn't changed. Lower peak, lower trough. That hasn't changed. Look what we've drawn here. Are we going to get the next lower peak? In other words, this is a very important question that's been asked here. Is this a corrective move that we're about to experience? It does seem that the markets have gone risk on. It does seem that it's going to be very difficult. It's going to be very difficult for us to ignore the fact that we're probably going into some sort of correction here. And the catalyst for that seems to me the weaker retail sales. And by the way, there's also a tick up in the University of Michigan consumer sentiment. But I don't want us to get completely optimistic here. We could be at the bottom, but I don't know. We could be. Okay. And if we're at the bottom, of course, this is a terrific opportunity to be looking to get involved in the market. We have seen the COPOC hinting at good value on the DAX. As Chris pointed out, there's probably some good value there on the Russell as well. The S&P, we're getting there. We're not quite there yet. We're getting there. So the question is, well, have we bottomed? Perhaps we have bottomed. Perhaps the DAX is the indicator that's turning up. Perhaps it's the Russell that's turning up. And of course, I would concede that's all true. What I don't want to get lost in is the fact that we're still trending down on a primary basis. We've got the lower trough. We've got the real potential to be in the midst of another bear market rally. If we're in the midst of a bear market rally, that's going to cause damage right there. I can say that with a fair amount of confidence that whoever is sort of trying to pick the bottom here, and if we are unfortunately only in a bear market rally, there's going to be damage. Okay. However, there could be a change in trend here. Okay. We may be at that bottom, but the COPOC hasn't turned up yet. But the COPOC's always going to be slightly late, it's a monthly, right? If we get something like this, remember, Anna, what tools? Just go back to the tools that we've always used. Nothing hidden. We're not changing anything. We just, if anything, just adding slightly more to get a better reading. If we get something like this, well, that changes everything. Because then we don't, sorry about that, let me just put that in there. Because then we don't have a downtrend anymore. In fact, then we have the uptrend. What's the problem with this? What's the problem with this? The problem with this is, of course, we're late. We're late to the party because all the sort of people that have been calling the bottom here are right, we late. I'm okay with that because there was people calling the bottom here. There are people calling the bottom here. Okay, and I'm sitting feeling pretty much okay. They're probably sweating, so I don't mind. Okay, I don't mind. The idea here is I'm okay to be late. I just need I need the higher trough, higher peak to be locked in. When I get the Copac turning up, then we'll have a completely different conversation. But we don't have that yet. What we do have is a downtrend. That we do have, because that's meeting the definition of downtrend. We don't have the uptrend locked in yet. We could be in the midst of getting an uptrend. I'm not going to call it until I have it. So we want to just be very careful about reading too much into media optimism. Not convinced. I could be right, but you know, who knows? So just be very, very, I think, honest with the analysis here. What's the problem of being late? What's the problem of being late to the party, so to speak? Because the trend is only going to register after the fact. Okay, so let's just do the. This is kind of what's happening in the DAX right now. Okay, it's kind of what's happening, except now we may be seeing this moving up, right? Now, if this actually is a meaningful bottom, then there should be a trend. If it's meaningful, okay? And at some stage, that trend's going to falter. So let's just put in our labels here. Okay, so we'll use this as a reference trough. Here is our reference peak. Here is our higher trough. Okay. Here is our higher peak. Okay. Those are the 4 points we need. So here's where the uptrend begins, but we're late. Clearly we're late because trough T was the bottom, but who really knew that, right? It's kind of the people that bought there were very lucky. Let's put in the peak over here. Let's put in the trough over here. Here is the lower peak, okay? And here would be the lower trough, okay? That's where the downtrend begins. That's also where the uptrend ends, okay? So we got to know our place in the market. Are we looking to call bottoms and tops? I would suggest that's not our place in the market, because if we're really trying to call bottoms and tops, we're really either sort of gambling, or we are moving towards, one would suspect, very, very odd ways of examining the market in terms of wave counts and fibs and all this sort of nonsense that keeps people, that works just enough times to keep people interested, right? So if our place, that the place that we operate on the red path, then the fact that we're late makes no difference. We'll be late in, we'll be late out, but we'll have the most fun at the party because we've caught the majority of the move. So that's kind of the spot I like to think that we're playing. It's definitely the focus of the webinars. Having said that, we don't have the party yet. You know, the invitations may be out, but we haven't arrived yet. Does that kind of make sense? So yeah, we could be at the bottom, you know. if this is a suckers rally, that's going to hurt. Just taking a look at a few. Okay, so Anna asks a really good question. What about oil prices? Aren't they helping? And I would suggest that lower oil prices would certainly help. What I think that we would need to be cognizant of is the reason of the capitulation. So if it's capitulating because there is a decline in demand, we must ask ourselves, why is there a decline in demand? And the question, the answer to that question, Anna, is, well, there'll be a decline in demands because it's not needed. So what wouldn't be needed? So let's just break it down. Let's just say there's a company, it's a logistics company, it's moving goods from town A to town B. It's got a fleet, let's say, of 100 trucks. And let's just say economic conditions means that they now don't have 100 trucks in operations, they've got 80 trucks in operation. So now their fuel spend is not for 100 trucks, it's for 80. And maybe that's what's moving the market. Is that good or bad? Well, it's part of the process. It's part of the process. You see, what's effectively happening here is there is some sort of adjustment taking place. So that there's no doubt. There is certainly adjustment taking place. So let's just look at this again. Theoretical. This is a really important model. So I know that we do a lot of theory and it's just tiring on a Monday, but just remember, you've got two sides to an economy. You've got the demand side and you've got the supply side. And that's in any market economy, okay? And we'll call demand aggregate demand. That's all the demand, all the individual demands, all aggregated together. Same thing for supply. Now, what has effectively caused the shock in oil has been largely a supply side phenomenon. In other words, supply has come off. So the bottom is, let's call this quantity in the market for oil, quantity of oil. So so effectively there has been less oil in the market because of supply side shocks. Okay, but then the price of oil is measured on the Y scale. So, and this makes sense. If something becomes scarcer, so the quantity of oil is becoming scarcer because there's less of it in the market, or something that's more more difficult to acquire, okay, should be more expensive. So there's the movement up. The question, of course, is where's the adjustment now coming from that's moving oil down? Okay, how are we getting the adjustment down? And I would posit that that's probably coming from the demand side, not from the supply side. I think we're still short supply. I think if you read sort of any articles on energy, they'll largely say supply is lagging. So if that's the case, we must have some sort of demand adjustment. Okay, so some shift from black AD down to red AD, and here we kind of get a sort of a new equilibrium, which incidentally, in this case, actually still has lower supply because lower supply is being demanded, but you also have lower price. So then if this is the way that it's going, we must ask, well, what's causing the red arrow? You see, so what's caused? So the cause with the less demand, again, is probably, for example, less trucks are being used in a fleet, less oil or petrol being demanded. Multiply that by airlines, although airlines are actually, they've picked up, but let's multiply that by all the logistic companies in a country. Then let's multiply that by all the logistic companies on the globe. Do you know what I'm saying? So that's so if there is so there's an adjustment taking place now. one last, I think, because we are certainly, I think we've done a lot today, so thank you very much. Let's just do one last economic chart, just one last, and then we're going to end. Yeah, exactly, that's what's called demand destruction. That's exactly what we're seeing. Okay. Now, economic theory, so the way that this whole year is playing out is actually, it's actually a really interesting way to test economic theory. So on a theoretical basis, it's very interesting. Practically, I mean, we're all paying such high prices. It's not so realistically. It's not so cool, right? But you've got inflation. Okay, inflation, and we've got now called. Let's just put on the bottom here economic activity. Okay, economic activity, exactly the same aggregate demand, aggregate supply pattern, but this time we're not talking about the oil market, we're talking about everything in an economy. Okay, talking about everything in the economy. So here, aggregate demand would include oil, it would include food, it would include services, it would include everything. Okay, but the economy, again, has largely been hit by supply side factors on both the oil, food, supply chain side. So there's been a shift in aggregate supply upwards. Okay, so that's where we've seen a lot of the inflation come from. Now, forget about the demand. Okay, I'm not going to adjust what I will say about demand is that monetary policy is addressing that curve. It's not addressing the supply, can't address supply. Okay. Fiscal policy addresses aggregate demand. Okay. Now, there is various schools, various schools of economics. One of these schools is what's called the classic school of economics. Classic school. Okay. So what the classic school of economics is that these disruptions to equilibrium are temporary. They say these are temporary. In other words, aggregate supply one ultimately is going to come back to just aggregate supply. Ultimately, it will. Okay, so you've got to ask the classical economist, well, how is that going to happen? Okay, how is that going to happen? And the classical economist will say it's going to adjust in the labor market. Okay, and how does that happen? Well, as the aggregate supply shifts from AS to AS1, economic activity is falling. And as economic activity is falling, people are getting laid off. And the more people that are getting laid off, the lower the pressure on wages. And the lower the pressure on wages, okay, the less company costs are. Costs come down, variable costs come down. Okay, so you have a supply shock in terms of your inputs. Then you have the adjustment taking place because labour start getting laid off. As they get laid off, we move back to AS. Once we get back to AS, all the unemployed have been rehired, and they've been rehired at a negotiated wage that is lower, but it's brought us back to equilibrium. What am I saying? I'm saying that this type of supply shock tends in economic theory to lead to employee pain. Okay, according to the classical school. I don't think you will find many schools of thought that deviate from that. So I'm not sure that this is happening yet. So we still kind of got to watch this part of the economy. And of course, as employees become less, as they become laid off, that leads to further demand destruction, etc., etc. That's where the adjustment takes place. Obviously, very theoretical, but that's what I say. It's very interesting to see how this year is playing out. because it's actually playing out pretty close to the theory, but I'm not sure if we've seen enough of that yet to get the adjustment. Again, what's the whole point of that? The whole point of that is, well, let's just be careful to not call the bottom just yet. Yeah, it could be there. I'm not saying it's not there. It could be there. Hey, that's fine. I'll come in a bit later, okay? Because if it's a bear market rally, well, you're going to get hit hard. I think that's where we'll leave it. Any questions before we sign off, guys? Yeah, Katie, lots of theory. Always seem to throw it to you guys on a Monday morning. Apologies. All right, I think we'll wrap up here, guys. Thanks very much, and we will catch up tomorrow morning. You guys got my email. Cheers, guys.